Hello, everyone. Welcome to another episode with me, Shashank Godoppa. And a lot of people are asking me a question that, Shashank, how are you finding stocks in this market? What is your strategy and what screeners are you using? So, today I thought let me give you a very quick rundown of how I scan my companies and let me scan it with you live. I will show you the screeners I use and I will also show you how I look at these companies because what happens is, see, I run different type of strategies. I run different type of baskets. As you guys know, we have two baskets. One is a quant basket where I run a very different strategy. In the quant basket, we basically run strategies which are purely momentum based, right? So if you see how this works, it works on a pure momentum strategy. If the market does well, this strategy does well. Then we have a compounding basket, which is fluid C. Again, this is a compounding basket. So this is a long-term compounding basket that has pure fundamental stocks. So if you see the stock and weights here, you will see it's pretty much mid cap heavy and large mid small, small and mid heavy, right? So this is basically how it's looked at. But if you ask me, Shashank, how do you screen companies for your personal portfolio, I will talk about that basically right now. So let's quickly begin. I don't want to waste your time as well. Okay. Now, coming to screen, let's do a quick understanding of what I like to screen. So, look, I don't like to be invested too much in buy and hold. I'll make a separate video on why I don't believe in buy and hold anymore, even though it is supposed to be the best strategy. I don't like it. But let me tell you how I try to find good companies in the market. First things first, we'll put a market cap filter. So, market cap greater than 1000 is minimum. But again, I'm a higher risk taker. So, if you don't like 1000, then I would say go for a little higher range. Start with 5000. Above 5000 means you will get all the Nifty 500 top companies. But above 5000 will give you a good safety net. Second, I don't compromise on the returns of the company. So returns have to be great. So first what I'm going to do is return on equity. I want 15% and above. Anything less than 12%, I don't even want to look at it. Okay, this is a very given take for me. Now I will show you the screener which I do to eliminate banks because I usually personally don't like investing too much in banks. But I'll tell you how you would also like to do that. But I personally don't like, and that is why I do debt to equity ratio less than 1. Ideally, some people do 1, 1.5. I am like 1 enough. Straight away, 1 is more than enough. I want EPS to grow. EPS greater than EPS last year. Now, why EPS greater than EPS last year, I'll tell you. Because sometimes you will see the sales are growing. Okay, you will see sales are growing. Profit also you will see grow. But this company might be taking a lot of QIPs constantly. So if a company is constantly diluting and growing, that means the growth is not very real because the EPS shareholder value is not coming across. So that's why I'm saying EPS of this year should be ideally greater than EPS of last year. And then a simple sales growth filter. Sales growth in the last 5 years, actually you can do 3 years now, greater than, let's say, 10%. If it grows, it's great. But let's take 12% as a higher benchmark. Okay, this is a very, what do you call that, targeted screen. Okay, because I want only good companies in this, not bad companies. Isme you can, if you want momentum, I can tell you how to add momentum, but I'll show you both variations. If you want to add momentum, you can say return over 1 year greater than. Now last 1 year, what is the market sitting at? Last 1 year market is sitting at literally negligible returns, like zero. I would say minus 8% is where the market is now. But if I say last 1 year greater than even 10%, that means it is going to give me companies that are fundamentally strong with high return on equity ratios, less debt to equity, EPS accretive, sales growth accretive, and it has given 10% return in the last 1 year, which means it is in the direction of growth. That means these are not companies that are sleeping. सोए हुए companies nahi hai. This is how it would be. So let me run this query and show you how this would look. As you can see, only 2 companies have come. One is ABB and Varun Beverages. This is because return on 1 year greater than 10% has become a little tough. If I remove this, let's say, because last year many companies didn't come in that criteria. If I remove this, you will see that we have 4 companies over here, right? Now, let me see where I can tweak this a little bit more. And let me tell you how we can change this a little. Oh, I forgot to put OPM also in this. So let me do that. Let me again paste this and I will add a few more stuff here. So what we can also add here is, let's say, I will change this to 5,000, return on equity 15,000. I've added return on capital employed at 15%. I've added debt to equity. I'll increase it from 1 to 1.5 so that I can get a little more idea of how things are growing. OPM, I can actually make this 12% instead of 10%. EPS last year greater than EPS the preceding year. And sales growth instead of 12%, I'm getting it down to 10%. If I run this, we have got 170 names. Okay, we've got 170 names. Now we will go reverse. If I reduce the debt to equity to 1, we go to 165 names. So I'm going to stick to less than 1. Great. If I increase this, I think 12 is perfect. EPS last year greater than EPS preceding year is perfect. I think that was the problem last time. Sales growth, if I increase to 12, it goes from 165 to 151. I'm very happy. So I want less names. I don't want so many names, right? Now we'll put the momentum filter and let's see if it works. Return over 1 year greater than 10%. Ideally here, even if I put 0%, I think it would be great because these are stocks that haven't fallen. But I have 69 companies that have gone up in the last 1 year with all these parameters. So let's look at the parameters first, then let's look at some companies. Parameter basically says market cap is greater than 5,000, which is amazing, right? That means it is a good company. Return on equity is 15%. Usually return on equity 12% is good. We are taking 15%. Return on capital employed means every rupee I put, how much money I get back is 15%. Debt to equity 1. That means it is not in the bad zone yet. Operating profit margin already operating at 12%. In this, what will happen? You will lose out on companies that are sitting at 8% margin growing to 12%. But if you want, to look at trading companies and all, then you can remove this as well. But if not, you can keep it for high quality picks. You can remove it also. I'll show you the difference. EPS last year greater than EPS preceding year. Basically, EPS is growing. Sales growth last 5 years greater than 12%, not 10%. That means 12% automatically means above Nifty. If the profit grows by 12, if the sales grow by 12%, the stock will ideally grow more than 12%, hence beating your average of 12% in Nifty. Return over 1 year 10% means it has already given 10% in the last 1 year, including all these parameters. So now I'm going to remove OPM and I'm going to show you. See, without OPM, after removing OPM, 65 became 89. I'm very happy. Only 10 more, 15 more companies to screen. I will do that. Now I have a list of 89 companies. Now let's look at this one by one. Now, in this, there are 2 hacks you can do. Okay, one hack I will show you. See, one thing is here, if you look at the P ratios, like you have 75P, you have 65P, you have 155P, you have 123P. Now, I'm pretty sure for taking new entries, I would not like to have a very high P ratio. Yes, sometimes, okay, there are some companies where you don't look at P ratio, but there are some companies that you just don't want to invest in the P ratio. So if you want to make it even more targeted, because if I'm doing new entry, I would not want this kind of P ratio. So let's go and put some more entry rules. I'll say P ratio less than, let's say 80. Okay. I know 80 is also too high, but I'm giving some leeway to play. I'm saying PEG ratio. Actually, let's not do PEG. Ideally, PEG is better, but let's not do PEG. I'll put price to sales. Actually, price to sales also I won't put. Let me just put P ratio 80. Ideally, I would put price to sales, EV, EBITDA, everything. But the price to sales will remove companies that are exchange type companies, will remove companies that are very high margin companies. So let me remove that and let me just do P less than 80. 77. So 89 to 77 comes. Then I'm very confident. Then I can go from 80 to 60. Let me check. Wow. Only 60 companies from 80 to 60. That means these are all companies that are investable for me. Obviously, I have to do more research, but these are companies that are interesting and I will do market cap split. And this is how everything comes across here, right? Now comes the actual deep dive and understanding of what these companies basically do. Now, if you look at Bajaj Auto, Hindustan Zinc. So before I even go here, how I play the mindset, I'll tell you. I'm very clear on what I want to look at. Okay. I know for this year, I have to be positioned in basically AI, data center. They might not be valuation friendly, but AI, data center, pharma, okay, healthcare, defense, okay, and maybe even EV, okay, a two-wheeler because of the whole oil. If I can find companies in this much, I think I will beat the index, okay. This is because I'm looking at the market every single day, so I know what might work, might not work. So that is what I'm going to focus on. So let's look at Bajaj Auto, which is coming here, Eicher Motors, Varun Beverages, not in the list, but let's see. Polycab comes under the wire segment. So let's look at that because I know all wire companies, whether it's Polycab, Apar, KEI, all are doing well, right? Lupin is in pharma. Let's keep that open. And MCX, not very keen, even though it might be a great company. I'm not very keen to look at it because already the recent run-up has happened. Ipca Labs, Ajanta Pharma, Naveen Fluorine, JB Chem. See, automatically, by the way, guys, I have just screened in front of you and you can see the trending sectors are already playing here because RR Cable, Force Motors, Newland Labs, it looks like majority of these are already in the sectors I mentioned, right? Kaplan, I don't want to talk about it because issues, my issues, not your issues. Shriram Pistons, CCL, amazing companies here, guys. Amazing companies. Now, why am I saying amazing companies? Because I've done research on many of these companies already. But these are some very interesting companies. SML Mahindra, FIEM, Goldium, yeah, if Origam works, yeah. So okay, I've opened a lot of tabs. So let's look at it one by one very quickly. So if I look at Bajaj Auto, right now Bajaj Auto sitting at, again, nothing is a buy or sell. I'm just doing some research with you. If you look at Bajaj Auto, it is sitting at 26p right now. If you look at the ROE, ROC is obviously great, right? So nothing wrong with the ROE, ROCs here. So for some reason, this has become slow. But if you look at this, the P ratio is comfortable. ROE, ROC is very good. Market cap to sales is 4x. Return over 1 year is 17%. That means it has beat the index. Free cash flow company. I want to look at historical P ratio to check if I'm over investing or is it a very high number. It seems like it is at a slightly higher end over here, right? If I look at the market cap to sales, also higher end. But this company looks definitely interesting. So it is not a bad company. I will go do a little more research on it because this company usually compounds very well, right? So I just want to check if the sales growth, which is growing because of the whole E2V boom, electric to two-wheeler to electric migration, will it continue or not? Because this is a large cap company, it's a great company. We look at Eicher Motors, again 37 P, ROE, ROCs are amazing because we filtered according to that. PEG ratio is 1.55, return over 1 year is 46% for a company like Eicher. Valuations are quite comfortable, right? And this is a long-term company. And if you look at the bottom, you look at the sales, how the sales have been growing in the blue. The sales have been definitely growing in the blue, right? So that is something that I really like. The sales have been growing. This is something very interesting, right? This is how it looks like. So again, this is a very interesting company. So this is something I would be very interested in. Then Varun Beverages, my old friend, I rode it very well. But Varun Beverages, again, coming back up, is doing a recovery because all the bad news has been factored in. So again, I would want to check, is the P ratio overvalued or undervalued? Actually, it's fairly valued right now. So this is something I would be very interested. Then coming to Mr. Polycab. Now I know for a fact all these companies, Polycab, Apar, KEI, RR Cable, all of them are doing good. And as you can see, the stock price itself is talking about it. But you see how I have screened the companies and how I have come to this arrangement. This is why I look at companies and I really like, okay, this, all of them. Okay. Apar to I've been holding for God knows how long. I think I'd invested in my mother-in-law's account at 80,000 rupees. I'd invested. It's up, I think, almost 500% right now. And I've not sold Apar yet, right? So this is something that is very interesting. Then coming to the pharma picks here, if you look at Lupin, again sitting at 18p. Pharma, we look at market cap to sales. Even there, it is undervalued at 3x. Again, I have to do a little more research as to why it is going up, right? Why is it reaching all-time high breakout? It has not even started the journey. But this is something that I would like to see. Again, there are many companies. For example, I'll just go to the important ones. Let's say like JB Chem. Let me refresh this. JB Chem is basically getting acquired by Torrent Pharmaceuticals, as you can see here. So this is happening very soon. But JB Chem is on an absolute rally. And it's not stopping anytime soon. It's still going because they're sitting at almost 30% margins. Look at this. It's really, really interesting company. You should definitely have a scan of this 27% operating profit margin, doing really well. And the profits are coming in. It is also accretive on the EPS. So all of these things basically give you a major push and basically just screens really good companies. Like the screen is very good. Like one more auto ancillary company, Shriram Pistons. See this? Absolute tear. Absolute tear. Story is continuing. CCL, something that we had recommended to our swing trading customers. Again, absolute tear. Look at this, doing really well because of that Continental Coffee is doing really well. We have Precall, SML, so many damn good companies. So if you ask me, Shashank, how do you screen these companies in this market? This is basically how I screen this. Let me save it myself also. This is what I'm going to do and I'm going to save this query for myself. Yeah, but you can use this query as well. As you can see here, you can take a screenshot. So I'll tell you some variations here in this query. If you really want some variations, what I would do is, so one variation is if you remove the return on capital employed and you remove debt to equity ratio, you will get banks. Okay. But again, banks, return on equity also a little weird. EPS is weird because they usually are dilute a lot. Sales growth, you'll have to increase a little bit more. So that is my problem with banks. But if you want, we can test it out. I can remove return on capital employed. I will remove debt to equity. And this is what I will do. See, SBI comes. So Adani Port comes. I don't know why Adani Port didn't come before, but SBI comes here. Then you will have Canara Bank coming here. Now, I'm not saying these companies are bad. SBI, Canara Bank, they've all given a very good rally. But it depends on what type of investor you are. As I told you, I am not a very banking heavy focused guy. I don't like banks so much. Even though, yes, banking is a very big part of our growth story. I prefer playing IT, undervalued gems like this. So this is something I look at. So if you ask me, I like playing it, with the two EPS and all of that, right? So if I have to play, I would play it with this kind of story where market cap is greater than 5,000, ROE 15%, ROCE 15%, debt to equity less than 1. And in this also, I can even make you a variation which is even more intense. Okay, if you want a very intense variation, like really good, you can actually do this. I'll show you. I can go for ROE greater than 20, means cream, like amazing to amazing companies. ROC 20, amazing to amazing companies. EPS growth, debt to equity less than 1, sales growth, make this 15. That means amazing companies growing very fast and have given one year return 10% and are sitting at less than 60p, you make this 40p. That means 22 companies today are at growth phase with good numbers and undervalued at this less than 40p and undervalued. So that means I need to go deep into these companies and figure out what is good and what is bad. Even if I get 2 or 3 right, I'm really good. But this is like really cream of the crop. But that is how I would play this as well. So again, the main reason for doing this video is so that we go deep, learn, understand. So I hope you've learned something today. I hope because sometimes we do video which is very surface level. Sometimes we do videos that are quite deep. This is a video that we went little deeper to show you the variations on screener. So I've shown you a variation without banking, with banking. I've shown you a very high quality screener, and I've showed you a normal screener as well. But this is where I look at companies. I don't look at any other companies. If I have to find good companies for this year, this is what I would look at. I would still have my biases. My biases are mainly derived from which sectors will do well. As you can see here, AI sector is not there because all of them are above P ratios. So fine, I will not. I was a little late to the party. But pharma, I can definitely play here. Auto, I can still play here. And these are some really great companies. Healthcare, I can play here. So that is basically what I would look at. But again, I hope these videos actually help you a lot because the market is just recovering. We still have 10% away from all-time high. So this is the best time to start learning and actually activating your positions. Again, I hope you guys enjoyed this video and liked this video. And if you did, please click on the subscribe button because this will really help my channel grow so that I can give more and more valuable content like this to all of you guys. It's free of cost. You just have to click that red button and that's it. But I hope you guys enjoyed this video. And if you have any more doubts, any more questions, please put in the comment section below so that I can help you with any doubts that you might have. And if you want a discount for the small case, let me know in the comments as well. I'll put the discount code there. I think it's SAVE20. You get 20% off and you can have fun with it as well. Awesome. This is me, Shashank Godoppa, signing off, guys. Take care. See you. Bye-bye.